Hi, my name is Chris Duffield, and I'm an account executive for Newline Mortgage. For about the next 30 minutes, we're going to talk about VA purchase credit analysis. If you could turn off all your other devices and shut your door for just a moment, if I can have your full attention, I'm going to go through this pretty quick so that we can stay within our time frame. I promise you it'll be some good information for you. The goal of this training is to make you familiar with analyzing the borrower's credit and what documentation could be required, making sure that documentation meets guidelines, and I'll help you kind of show you how, give you some tips on structuring your liabilities. Before we get started, I need to mention that this is the 5th training in a series of trainings designed to familiarize you with the VA purchase product and how to originate a loan based on VA purchase guidelines with Newline Mortgage. Some of the previous trainings we've covered how to pre-qualify a veteran, what forms and disclosures are required, and an in-depth analysis of the 1003. And then some future trainings I have will show you how to take all this information and apply it to the loan and what you need to do to process your loan, get it approved, and get it closed. Also, I'd like to take a moment and ask for your business. As an AE, I'm paid commission, so the best compliment you can give me is to send me a loan. If you find my trainings useful and learn something new, then please do send me a loan. Okay, let's get started. So looking at VA purchase loans, this training will help you begin your credit analysis and help you to either begin or continue your list of required documentation. We have covered a lot in the trainings leading up to this regarding documentation requirements. And this is just part of that, and like I stated earlier, we're going to go through in future trainings and show you how to apply all this documentation to your loan. Right now we're going to cover the credit report, we're going to review that, we're going to analyze some liabilities, or analyze liabilities, go through some VA liability guidelines along with Newline overlays. What I'd like you to do is to take the mindset and analyze the file from an underwriter's point of view and review the file as if you are loaning the money. If you have a question, the underwriter will have the exact same question. Don't be afraid to dig in because you know our underwriters will. If something doesn't make sense, then question the borrower. Don't wait for the underwriter to ask. It's actually our job to have the file read like a book, which tells a story. And it's better to have that story come from us initially than make it up as we go along. That's a great analogy of how conditions pop up and how a lot of conditions pop up and how conditions breed conditions is because we're telling a story as we go. We're not even telling the story. We're making it up as we go. So, we really need to take on getting a complete story, getting the complete documentation, and making a presentation to the underwriter that reads like a book. You'll get a lot less conditions, a lot less headaches. So hopefully the information on credit today is going to help with that. So reading the credit report, most of us are familiar with credit scores. All borrowers have to have a qualifying score. Newline requires a minimum of 2 credit scores, and the lowest score will be used. The qualifying score will be the lowest of the middle scores for all borrowers. So here you've got a snapshot of what a credit score could look like on a credit report. In this particular analysis, we've got a 758, a 780, and a 756. The mid score is 758. If we had 1 borrower, that would be the score. If we had 2 borrowers, we would look at their scores and take the middle of that score. And then you look at the borrower and the co-borrower, and you go with the lowest of the middle scores. Scores come with reason codes for essentially why the score is not higher. There is no way to determine what a credit score could be if any of these reasons are addressed. However, most credit agency providers offer some type of rescore service. There are services out there where you can punch in a scenario if a borrower paid this off or paid this down, what would it do to a credit score? That, is definitely available, and like I said, most of the credit agencies have them. if you want to, have a brief conversation, get your borrower thinking, sound educated, educate your borrower, take a look at these reason codes. So you've got a score here of 756. It could be higher, but there's 4 reasons here why it's not. Not such a big deal on a 756 score unless you're trying to maybe get it higher to improve your price. But if you're working with a lower score, this information could be a lot more useful. All right. Credit history. So you've got the credit history on your credit report. Typically, the credit history will have a column to determine if the account is held jointly, held by the borrower, or held by the co-borrower. The creditor, loan number, and type of account are also listed. Make sure that your loan number matches any statements you might provide. The date the account was last reported to the credit agency by the creditor, the date the account was opened, and the date of the last activity are also listed. The credit limit for credit cards or the original loan balance and repayment amount are also listed. There are basically 2 types of loans, loans with fixed payments and loans with payments that revolve around a credit limit, known as revolving payments. Fixed payments are usually assigned to mortgages, autos, or maybe luxury type items, boats, campers, things like that. Revolving payments are assigned to credit cards. If any amount is past due, that amount is listed as well. And the payment history is listed using a 30 to 90-day grid along with the current status of the account. The status of the account is typically as agreed, charge off, or settled. So in this snapshot, you've got these first couple of columns right here. And we all know that we all use different credit reporting agencies. Some agencies more than others, so they do vary. So I apologize if this doesn't look exactly what you're used to seeing, but it should be in a very similar format. At least you'll have the same information. It just might be in a different format. But this first column here represents basically whose debt this is. It could be a joint account. It could be B for borrower account. It could be C for co-borrower account, or it could be I for individual. In this particular case, it's J for joint. So these are all joint accounts with somebody else. And this account down here was in the name of the borrower only. And then you've got the creditor information. So you've got the name of the creditor, the loan number, and sometimes there's miscellaneous information. Like in this example, we know that this is a VA real estate loan. And we know that this account was closed by the consumer's request. The thing with the account numbers here is, let's say you need to provide a statement. Maybe something's been paid off, or you're trying to verify a different payment amount, and you've brought in a credit card statement or a mortgage statement. Make sure that account number on that statement matches your credit report. If it doesn't, that could be a big problem. The date reported, so this is the date that the creditor reported to the credit agency. That's the last date it reported. You'll notice this report, you can't tell, but it was dated 3/22. So all of these reported dates are fairly recent, which works, except for this reported date is 1/13, and the credit report is dated 3/22. Where this could come into play is, on this particular example, this home has been sold. So that was the last time the borrower made the payment. You can tell down here by the date of last activity. So the borrower last payment was on 1/13 and they sold the home. So that's why this report date is old. But if it wasn't, if this was a current and active mortgage, we would actually condition for this to be updated to reflect the most recent payments. Over here, you've got your date opened and the date of last activity. So this is the date the account was opened. This was the last date the borrower made payment. And then in this column, you've got your high balance or your original loan amount and the account type. So the original loan balance for this mortgage was $176,000. The original balance for this auto loan was $18,305. This credit card has a limit of $5,000, and this credit card had a limit of $4,000. And then over here, you've got your current balance and your payment terms. It's pretty self-explanatory, pretty easy to look at. When you get down here to the revolving debt, this is a credit card, and they put the minimum payment on here of $109. Now, just a little bit of a tip for you guys. If you're structuring your DTI, and if you're close, and you need 1 or 2 percentage points, like you're just that far over, you're shaving off numbers wherever you can get them. One place you could shave off numbers is get a credit card statement from your borrower. It could be likely, since on this particular case, their last payment was on 2/13. This credit report was dated 3/22, so they may have made another payment since then, and they could have reduced this a little bit and reduced their minimum payment. When you're trying to shave off some debt to get your DTI down, that's one trick that I used to use. Is I would go to the revolving accounts and see if that's someplace I could start. So just that little tidbit. Another tidbit while we're here is if you need, let's say this needed to be paid off in order for the borrower to qualify 100%. First of all, you can't pay off revolving debt to qualify if it shows up with an outstanding balance. Regardless of the debt, if it needs to be paid off in order for the borrower to qualify, the best thing you can do for everybody involved is to get that debt paid off, repull your credit, and then run AUS after that. Otherwise, we are obligated to document the source to pay off that debt and down to the penny. And, you know, I'm not saying that that couldn't come up somewhere else in the underwriting. A lot of times it doesn't. Sometimes it does. You know, there could be other things in the file that were meant to be in there or not meant to be in there, you know, whatever the situation. Other questions that the underwriter has in other areas, and in a roundabout way, you could get, oh, that was just recently paid off. I need to know where the funds are. But if they pay it off and then you originate the loan and run LP or DU, then it shows up as a paid debt. And there's a pretty good chance we're not going to question the source of funds to pay that off. I'm dealing with a situation, this comes up right now, where I've got the payoff of a debt from different sources, a gift from a couple of different sources. And it's all acceptable and it's all going to work out, but it has been hoops to find out who's made what payments, get gift letters, and luckily it's all family-based. And like I said, it really is working out, but we have gone through quite the documentation hoops to verify that was paid off or how that was paid off. And then if any amount is past due, that will list here. And of course, any past due payments have to be brought current if we're able to do the loan at that point. And then you've got the number of months reviewed here. So let's say on this mortgage, you know, it's been open since 4/09. But over here, maybe they only reviewed 8 months. That should prompt you to go through the rest of the credit report and see perhaps if that loan has been sold, you know, if the servicing of the loan has been sold and it was with a different mortgager. Otherwise, an underwriter may condition for a longer credit rating. And then over here, you've got your payment grid, the credit history grid. Of course, they could have 30-day late payments, 60-day late payments, or 90+. And then over here, you've got the status. I said earlier that the status is either as agreed or a charge-off or settled. It's important to know that because sometimes over here in this column, you may not see a late payment. But over here in this column, the word settled will be there. And there may or may not be anything over here either. So you've got no indication over here that there's any kind of a settled account. You've got, you know, this payment history here is good. And so you might at that point just breeze past that account and not notice that the word settled is over here. If it's settled, of course, that's derogatory. That means it was settled for terms other than the original agreed upon terms. So make sure that you're checking your statuses and there's no issue there. Okay, so as you're reviewing the credit report, there's some things that you want to check against the 1003 for. And of course, you want to match the liabilities to the 1003 and the schedule of real estate owned. You want to check and make sure there isn't any undisclosed debt on that credit report that they didn't disclose on the 1003, especially if it's a mortgage. That could be a bigger issue. You'll want to review inquiries. We will need a letter of explanation for any inquiries in the last 6 months from your borrower, and the underwriter is looking for additional debt. So if that inquiry letter brings up additional debt, please know you're going to have to verify that. Make sure there aren't any undisclosed delinquencies. So pay special attention to the late payments in the last 12 months. We definitely cannot have any lates in the last 12 months on a mortgage. Other delinquencies could be an issue, but maybe not, just depending on how many and when they were. Undisclosed payments. So if that credit card up here didn't have a minimum payment already listed, use 5% of the outstanding balance for your minimum payment. If ratios are tight, you may want to ask for, if ratios are tight, you may want to ask the borrower for a credit card statement like we talked about earlier. Your borrower does qualify with the minimum payment for any revolving account. And as far as the payment history is concerned, what we're looking for is an overall pattern of good credit or an overall pattern of bad credit. Assuming the borrower's credit report, in this example, the rest of that credit report looks like this, we've definitely got a pattern of good credit. Okay? If there was, maybe one delinquency here, and like a one-time 60, over 12 months ago, a couple lates before that, doesn't really feel like a pattern of bad credit. But if they've had like 3 or 4 lates 2 years ago, a couple more, like 5 lates, say a year ago, and then 1 current late, that could be a pattern for delinquent credit, like the borrower's heading into, more of a delinquent credit pattern. And if we're looking at a cash-out refinance, that's a big deal. So we've kind of got a history of increasing lates, and now the borrower wants to cash out. Or we've got a history of increasing lates, and we're at max financing, gift for down payment, exceeding the DTI, trying to find compensating factors. Look for patterns in your borrower's credit payment history. It's either good or bad. Sometimes it is hard to tell, but your underwriter will take that mystery away for you if you can't tell. Okay, on collection accounts and charge-offs, typically they're itemized outside of the credit history, so they're located at a different place in the credit report. Collection accounts and charge-offs may or may not need to be satisfied depending on the severity and if the underwriter feels the first lien position is threatened. You will need to document the source of funds to pay those off if required. Judgments, tax liens, foreclosures, and bankruptcies, those are typically located in the public records section of the credit report. They may or may not need to be satisfied, judgments and tax liens, depending on their severity as well. And, of course, if the underwriter feels first lien position is threatened or not. If those are paid off, you do need to document the source. Know our BK and foreclosure guidelines. These are overlays. Chapter 7s have to be discharged for 3 years. Chapter 13, discharged or dismissed for 3 years. Foreclosure, 3 years from the date of the trustee sale, and a short sale is 3 years from the date of the short sale. The AUS does take a lot of the work out of reviewing a credit report. However, it's good practice to know the report using the information in this training. If the underwriter is questioning the borrower's ability to repay the mortgage, or we're looking at a high DTI, it's good to know where to go and how to review if the borrower is a heavy credit user, recent credit user, maybe has the beginnings of a pattern of bad credit or otherwise. AUS will approve loans for borrowers that have recent delinquencies or a lot of debt or recently acquired a lot of debt, and underwriting may have a question or an issue under some of those circumstances. So your AUS is not the be-all, end-all of your loan approval. There's still a credit analysis, and then as we all know, we're going to get into income and debt analysis as well and employment history. So the AUS, like I said, really more or less, well, it's not the be-all, end-all. What it really does is assess the risk level of the loan and puts it in a certain risk category. We still have to go through and document that the data we entered to get that AUS approval and get it in that risk category is accurate. The data has to be accurate. The borrower still has to demonstrate an ability to repay the mortgage loan. Okay, so you've reviewed the credit report. You've checked it against the 1003. You've answered all your questions there. You're clear on, if the credit report is accurate or not, if you've got all the debt properly accounted for or not. Everything kind of matches on the 1003. There's not really any discrepancies. Getting ready to submit it to AUS. You may want to run through the liabilities as well and double check and make sure they're structured correctly so that you have a proper DTI. There's a few things here to remember. You may not have to count short-term debt. So if you have a payment, a debt with less than 10 months payment, you may not have to count that. If it's a $50, $60, maybe even a $100 payment, you may not have to count that in your DTI if the term is less than 10 months. And this is for installments accounts, okay? So installment accounts only. If it's revolving, you're going to have to count it. But if it's a higher payment, like an auto loan with a $350 monthly payment, you're more than likely going to have to count it because that could have an effect on the borrower's ability to pay the mortgage for the next 10 months. So you need to work with your underwriter to find out if they're going to count a payment or not on a short-term debt. You do not have to count student loans if deferred for 1 year. You do not have to count debt awarded to an ex-spouse unless the proper documentation cannot be provided. You do not have to count cosign debt if the borrower can document they've not made a payment in the last 12 months and that they are a cosigner or authorized user. This does include mortgage payments. You want to check for child support or alimony and see if that's a debt or not. Check for an HOA fee. Always double check that, especially if you're working with a PUD. I mean, double check it if you're working with a PUD. A condo, it's pretty obvious. But sometimes borrowers don't know that they may have an HOA fee if they're buying into a PUD. Check for unreimbursed employee expenses. So remember, we talked about this previously in one of our classes. Don't ask your borrower if they have any business expenses. Ask if they've filed unreimbursed employee expenses on their Schedule A. If they have, then that has to be deducted from their income. In fact, go one step further, just get the first 2 pages of their tax returns. This gives you their address and name information for your 4506T, and it also discloses if the borrower itemized and what was on that Schedule A. If the borrower is keeping their current residence, so you've got a veteran that's keeping their residence and buying another home, maybe with another VA loan, the borrowers must qualify with full payment unless they have a 25% equity position, evidenced with the 2055, a lease agreement, evidence of deposit and first month's rent, and it must be an arm's length transaction. Okay, well, I think that's it. I think I've covered just about everything. Remember, I'm only a phone call away if you need anything. If you found my training useful, send me a loan. My name is Chris Duffield. I'm with New Line Mortgage. My phone number is 801-759-8521, or you can email me at kduffield@nlmtg.com. Thanks and have a great day.